So it's not simply the case that we have a straightforward answer. We have a hypothesis here and no good explanation. Why is this exuberance limited then to financial markets? Why don't we find it in the shoe industry? Why don't the different producers there pursue investment strategies, producing particularly fancy types of shoes for, I don't know what segments of the population, and then, well, risk simply going bankrupt? And they don't do it. Similarly, in the car industry, you pick the industry. It's the financial markets very predominantly. So why don't we find this general law of entrepreneurship according to the Keynesians in other markets? And then if we look at the empirical record, we will find that it has not always been so. Until the mid of the 19th century, very roughly, banks were operating in most countries at very high equity ratios. For example, in the free banking system of Massachusetts that we had until the mid-1800s, the banks operating in that state and the neighboring states had typically more than 50% of equity on their balance sheet. And similar figures we find in other countries. Now, things were running down the hill from there. We can, if we look at the historical record, observe a slow but steady tendency toward the reduction of equity ratios, which made the whole industry more vulnerable. This brings us then to what I think is the true cause, or the true ultimate cause of the fragility of financial markets, and that is our current monetary system. In our current monetary system, we have a lender of last resort, namely, well, several lenders of last resort, which are the central banks, and which produce an economic good, namely paper money, that can be produced at virtually zero cost. And the banks know this, and the banks know that this gives them the possibility to produce as much money as they wish, without physical constraints and without commercial constraints. Right? Overproducing, they cannot go bankrupt. They do not confront any supply problems. Factors of production are missing, and so on. So they have the possibility to bail out any market participant that is in difficulties and thereby prevent a meltdown of the financial markets. Central banks can prevent that a domino effect or contagion effect plays out simply by extinguishing the fire when it first presents itself while it is still small. And not only can they do this, but that is their official mission. They constantly say that they're doing this. You go to the website of the Federal Reserve, and you go to the website of the European Central Bank, and you will find that one of the missions of these institutions is precisely to stabilize financial markets. Now, what is the implication of this? Because this is advertised day in, day out, and because historical experience proves that central banks have acted according to their professed objectives, they have bailed out the market whenever such problems arose, there exists now a perverse incentive for financial market participants to behave in an irresponsible way. And we can now see that the two unsound business practices that we mentioned a few minutes ago result precisely from such an institutional framework that creates the incentive for the market. It's because banks know, well, if I am big enough to drain with me the entire market into the abyss, if my failure is big enough to create other bankruptcies and just to create a meltdown of the financial market, well, then I can count on the assistance of the central bank. If I can count on the assistance of my central bank, well, what will I do? I will reduce my equity ratio. Let me give you just, because there are many students here, I'll just give a numerical example. Let's suppose you're operating a bank that has 1 billion euros of capital and generates 100,000 euros of profit. Okay? Operating with an equity ratio of 50%. So let's say now it serves the debt out of these profits, 500,000 times, let's say 5%, so 25,000 euros. So there remains 75,000 euros that are paid on an investment of 500,000 euros. Okay, so you get a 15% return on equity, 15% return on the money that you yourself have put into the company. Now let's suppose the company reduces its equity, takes out $400,000, euros, spends it elsewhere, and refinance these 400,000 by debt. And then it pays on the debt again 5%. So now it pays $900,000 times 5% is 45. So it remains 55,000, not dollars, euros profit on an investment of 100,000. So by reducing its equity, the bank is able to increase the return on equity from 15% to 55%. Now, so it's very simple, so there's a very strong incentive to do precisely this. The only reason why we keep equity is to immunize us, to protect us in case of an unforeseen event, unforeseen contingency, something goes wrong with our investment, and we want to prevent our default. Do not want to go bankrupt. But if we don't go bankrupt anyway, because the big brother is there somewhere and will give us the funds necessary to survive the crisis, well then of course there's no reason to keep any equity at all. We can actually reduce it to zero. There's no point in keeping any equity. And that's the reason, ladies and gentlemen, why we can observe empirically, I have observed empirically, a very strong tendency toward the constant reduction of equity ratios. And actually, in the past 20 years or so, it was mainly because through various legal interventions, governments throughout the OECD countries and other countries as well have imposed minimum equity ratios, that the tendency has not been even stronger, that we have not approached zero yet. Okay? So the financial market fragility can be explained simply by the presence of a lender of last resort. But the same institutional framework also explains the excessive risk-taking on the side of investors. And it's simply for the same reason. Why are we careful in the case of an investment as far as its risk is concerned? Well, simply because it will fall back on our equity if something goes wrong. But if we don't have to care about losses because we will always be helped, then we have a tendency, we have an incentive to neglect the risk side and just look on the possible profit side of any investment. Right? So here we have then an explanation of these two symptoms stemming from the same source. There is one alternative explanation that is offered in the mainstream literature, and this relies on a particular theory of market failures, so-called information asymmetries. According to this theory, institutional investors, banks and investment companies, know more about the relationship between possible profit and associated risks of any investment than their customers. So you, as a depositor, you put your money into the bank, and the bank then, you make an investment, tell your banker that you would like your money to be invested in this and that way, and the banker goes on to invest it, but he actually knows more about the product. Because he knows more about the product, he can sell you a lemon. Okay, that's a standard example from the information asymmetry literature. That is, he can sell you a financial product at the same price, a bad financial product at the same price as a good financial product. Now, a good financial product would be characterized by a better combination between risk and possible return, whereas a bad financial product would have an excessively high risk associated with a given return or an excessively low profit associated with a given risk. So they can do this and exploit this information by exploiting the information asymmetry.